Deepan, the next point then is, right now, is everyone being a bit myopic? Stocks like Wipro, Dr. Reddy's, TCS, Lupin, Infosys, HCL Tech, I mean, the top 7 losers are all the leaders of the erstwhile rally. Do you think it's a good time to buy some of these, or has time come to actually move money out of these and move to the underperformers?
So I think one of the reasons why banking stocks and some of the capital goods are doing well is because I think incremental investment flows are going into those counters for one, and marginal selling pressure and some of the defensives and the erstwhile leaders is causing the underperformance which we are seeing there. A bit difficult to really answer whether it's a good strategy to get into the defenses, because then you're making a call on whether we have a stable government at the center or not. But my sense is that I would not like to do that complete turnaround from the export-oriented to the domestic-oriented at this point of time, and maybe wait and watch, and closer to the elections, if there is a generally conviction that we will have a stable government, then start making that entire shift. Because at the same time, a lot of the defensive stocks which have done well, the valuations are certainly at a premium to the market. On the other hand, the domestic-oriented companies have been underperforming, and valuations certainly support them, but the earnings are not flowing through. So it's a bit of a complicating picture, and I think it's important to have a more balanced portfolio now than ever before, which means have good percentage in all the performing industries and some of the industries which have been laggards as well. But investors should keep in mind that the quality should be excellent and the companies they invest in should be more or less debt-free.
Dipan, do you think 7,000 is something which is in reach for the Nifty? And would it be even something which is sustainable in your opinion if that's the case?
See, all I can say is that, a bull market knows no high. And there is a lot of money waiting on the sidelines, retail money and FI flows, domestic institutional money, I guess mutual fund as well. And there are hardly any supply of stock, with the exception of the insurance companies, and that also should dry up now that there are no compulsions to supply to support the PSU disinvestment program. And there are no IPOs coming in, or for that matter, follow-on public offers or preferential allotments. So you have that, demand-supply mismatch playing into the market at this point of time. And that may continue for a few more weeks, because by the time you get fresh supply of stock or new issues, it generally takes a couple of months for those issues, whether private placement or follow-on public offers, to come through.
Anup, chartists would say that once you enter uncharted territory, really maybe you don't draw further line. But going forward, what would be the zone where you think the Nifty would struggle next in terms of crossing over?
So I basically, when the breakout happened and when you extrapolate, that level was coming to closer to 67.20. So that's where I would be, watching out carefully as to what is overbought. Can you take some money off the table? Is there a rotation of sector which would probably take again there, moving out from, probably beta stocks to again safety stocks? So I think that would be one level. And then closer to the 69.40 to 7,000 zone, that 50, 60 points would be very, very difficult. So you may be able to cross 67 because it looks like, we've done such a sharp rally over the last 5 days and there's no correction. I think what will happen is probably even if we have a consolidation which is sideward, people would be willing to jump into the market. So this is a different euphoria and the volumes are kind of confirming that. So I think 67 is definitely the first target, and if we can hold that definite resistance around the 69.40, 69.50, but that's still, if you look from here, that's about 7 to 8% still away, and stocks may do much more than that. So I think there's a lot on the table.
UR Bhatt is also with us. Mr. Bhatt, hi, good morning. Did you imagine that 6,500 mark would be here so soon? And is the market getting a bit ahead of itself?
Yeah, I also did not expect that it is 6,500 so fast, but it has, and it's good for all the bulls. But I think the fact that, say for example, if you see the option data, you will see that the VIX has gone up so dramatically. From about say 10-12% to about 15, 16, 17%. So which means that option writers are demanding much higher premia to write options and take risks on the books. So which is suggestive that I don't know whether this will really last very long, because I think the celebration on the current account deficit coming down, I think is overdone. But anyway, 6,500 is a very important point in the history of the market. So therefore, I think it's time to celebrate. Let us not keep saying that there may be things which will bring it down. I'm sure it will come down. I don't think this is sustainable for very long.
Okay, Mr. Bhatt, I just wanted to take that point forward because interestingly, ICICI Bank is up 7% today. It's risen over 20% in Feb 2013, since Feb 13th itself. But if you read a couple of reports that came out post its Q3 numbers, there's the restructured loans rose over 50% on a sequential basis, and the Q4 pipeline is looking quite terrible according to most of the brokerages or analysts as well. In that sense, do you think that earnings are not going to justify the PE or the price to book that these sort of stocks are going to be trading at least for the near term?
Yeah, I think banking as a sector, especially the large banks, the public sector banks and the large banks, certainly have a problem in their hands. I think given the state of the economy and given the prospects of softer growth numbers, I don't know whether they will really be able to bring down this restructured book or bring down the level of NPAs. So I think the celebration is a bit too early. And even, say, for example, even if NDA were to form the government in May, I think to sort out issues of the slowdown of the economy, it will take quite some time. Finally, my thesis would be this, that, sentiment can take the market thus far. After that, it has to be backed by fundamentals. It has to be backed by earnings growth. It has to be backed by interest rates which are softer. And it has to be backed by FII flows. So FII flows have been all right for the last 2-3 days. But if you really see the first 2 months of this year, when the taper was on, the total money that is coming to FII is about 360 million. Compare it with the 2 months of 2013, where something like about 8.5 or 8.6 billion dollars came. So therefore, there is a dramatic impact in terms of FII flows also. I think it is just that the market is celebrating a bit too soon about everything being fine with the Indian economy post-May.
Okay, Mr. Bhatt, thanks a lot for your time. One final question to both Anu and Deepan before we let them go. Anu, one stock that you would bet on from current levels?
One stock that I would bet on current levels, well, as I said, I prefer infra to banking at the moment, because as I said, the selling will also first come into banking when it starts. So I think Larsen here and on dips is a definite pick in the large caps, and in the small caps it would be Voltas and Crompton following it, mid caps.
And Deepan?
Not one stock, but I think I said earlier, I think the private sector banks and NBFCs look interesting. So Yes Bank, Development Credit Bank, IndusInd Bank, all look interesting. And amongst the NBFCs, the likes of M&M Finance, Bajaj Auto Finance, and maybe even something like L&T Finance also could be quite interesting.
Okay, all right, Anu, Deepan and Mr. Bhatt for joining in and taking us through what has actually been a very interesting afternoon for